So the first topic is overview of financial management. Number two is called financing decision. Financing decision. Number three is financial institution and markets. Number four is the time value of money. Those are topics. Topic number five is business / financial assets and valuation models. Business models, business / financial assets and valuation model. Topic number six is introduction to capital structure decision. I'm hoping that you're writing them down. Topic number seven, introduction to capital budgeting decision. Introduction to capital budgeting decision. Topic number 8 is financial statement analysis and forecasting. Financial statement analysis and forecasting. The next one is working capital management. That is topic number 9. Working capital management is topic number 9. Topic number 10 is dividend decision. Dividend decision. Topic number 11, introduction to portfolio management. Introduction to portfolio management. That is topic number 11. Topic number 12 is Islamic financing or finance. Islamic finance. Topic number 13 is personal financial management. Personal financial management. This one is Islamic financing or finance. personal financial management. That is topic number 13. Topic number 14 is called contemporary issues and emerging trends. That is the last one. Please kindly let me know when you have copied all of this so that we can start. Are we done? We can start. These are the topics that we're going to cover in the semester. Let me know when you're done. Now, topic 1, 2, and 3 are basically theories, but they like setting them in exam. Topic number 1, 2, and 3 are theories that normally come in exam. Unfortunately, most students ignore them. Most students focus on calculations and then they forget theory. I want you to understand that 25 marks normally come from this area. So it means that if you are able to understand the theories, then you are already good with the 25 marks. Normally, the pass mark for CPA is 50%. But if in exam you are able to get 47%, the examiner will always look for the extra 3 marks to make you pass. So some people always say that CPA is difficult. They are saying that CPA are biased in terms of marking. I can assure you, because I also do marking, I can assure you that this paper, or CPA basically, they are very fair. It is the students who normally make some mistakes. Number 1, they join class late. Number 2, they have excuses that they are busy, they're not able to attend class. Number 3, they are always saying that they can read and study alone. So at the end of the day, you find that only 50% of students pass exam. And even the last setting, only 50% of students pass exams. So the remaining 50 will always come next semester. And it goes around like that. Every semester, students will always complain, they come back, they complain, they come back, but they never change their tabia. They start class late, they always wanajifanya ati wanajua, wanazajisomea, and then they come and fail and blame CPA. And they are always trying to say that they are busy doing other things. Weekend, they are going out, weddings, birthdays, they have parties. At the end of the day, they are not consistent. If you are consistent with the class, you'll always definitely pass. So the secret in CPA, make sure that you join class early, you attend class consistently. That is it. The pass is guaranteed. So let me know whether you have copied that. My name is CPA Dennis. For those who are joining me, CPA Dennis, I teach CPA, right? So I want you to let me know whether you have copied all of it so that you can be able to start with the topic number 1. Nataka tu niambie umemaliza kukopi. You can't hear me. Mwalimu, we can't hear you. How many people cannot hear me? How many people are not able to hear me? Japheth, John, can you hear me? So Infinix is done. So if you're done, then let's start. So we shall be following the topics and make sure that all these topics are covered. Eh? If you have not done any, you can remind the teacher. So I want us to start with the topic number 1. I'm repeating topic number 1 is theory, but some students always ignore it. So I want us to start with topic number 1, which is very important. When you are done with CPA, you expect to become finance manager, not just accountant, finance manager. So accounting will go to the accounts areas like the financial reporting, but finance management is about managing finances. So a good CPA should be able to understand the finances and should be able to understand the accounting part. So we need to understand who are these finance people and what are the difference between finance and account. Accounting deals with figures. They always get the entries, post the entries, and get the report. But finance people always use that report, analyze it, and make decision. So therefore, finance is about decision making. You need to make decision on how best you can utilize the resources that you have as a finance person. It's about using your mind or thinking to make decision. So I want us to start with the topic number 1 and write for me there, overview of financial management, topic number 1. And then you say that financial management refers to operational activities. Financial management refers to operational activities. Financial management refers to operational activities. Financial management refers to operational activities used in obtaining and effectively utilizing financial resources. Used in obtaining and effectively utilizing financial resources. Financial management refers to operational activities used in obtaining and effectively utilizing financial resources. Utilizing the financial resources in the most efficient and effective manner. In the most efficient and effective manner. So in financial management, which is the top unit, we are concerned with getting the resources, allocating them to ensure that they are effectively utilized so that you can get the maximum output. So therefore, this process involves a lot of things. So you can say activities involved in financing management. Activities involved in financing management. Activities involved in financing management. Number 1, investment activities. Number 1, investment activities. Financing activities. Financing activities. Financing activities. Budgeting activities. Budgeting activities. Risk management. So as a finance manager, you need to understand how to invest. You need to understand how to finance. That is basically getting loans from outside to pump in the business. You can finance business through loans or through savings, which is the owner's capital. So it is investing, financing. We have the next activities that involve, which you need to undertake, is called budgeting activities. You need to budget with the few funds that you have. Budgeting activities. Then we have risk management activities. Risk management activities. Let's now look at the roles and responsibilities of finance manager. Roles and responsibilities of finance manager. As a finance manager, whenever you're going to work as a finance manager, do you know your roles? So roles and responsibilities of finance manager. Roles and responsibilities of finance managers. And the first role, you can say that these roles can be classified into two. These roles can be broadly classified into two. We can classify the roles into two. We can classify the roles into two. We can classify the roles into two. These roles can be classified into two. First one is called managerial function. The first classification is called managerial functions. Or roles. And then the second classification is called routine functions. Or roles. So I can see, Sarah, you have a problem with the network. Sarah, you have a problem with the network. It keeps on logging you in and out. You are in and out, right? Now, what you can do, you can use network as Safaricom. Safaricom has got very strong network. I hope that is what you're using. If not, kindly try. Buy data bundles of 20 shillings. You're going to have 1 GB for 1 hour. Very strong. And you can be able to use it anywhere. So try Safaricom. Buy data bundles for 20 shillings only. 1 GB for 1 hour. That will take you for 1 hour. If you think around 55 minutes, you can buy another one before 1 hour ends for another 1 hour and you're good to go. That is what you'll be using when you're attending classes. Then you attend class, even using your phones. You don't have to use your laptop, all right? Okay, so let's look at the roles of management or finance manager. And we are saying that the roles of finance manager can be classified into two categories. There are roles that relate to the function, and then the roles that relate to routine duties. When we talk about the functional role or roles that relate to the function, these are roles that are contained or they are being performed by the fact that they are in the finance department. It is roles that relate to the finance department, not the routinely decision-making functions. So under roles of managerial function, we have the first role of management is called financial planning and forecasting role. Financial planning and forecasting role. So the roles, you can say, number one, financial analyst, managerial function roles. The first one you say financial planning and forecasting role. That is a role of manager, finance manager. So under this, we are saying the finance manager should develop a budget to focus what the future expectations are in terms of revenues and expenditures. As a finance manager, you need to plan, focus, look into the future, what your financial requirements are going to be, and the resources that you have, and the sources of revenue. All right? So you need to make such kind of budget estimates of the organization and how you're going to finance the operations. The next one is called the financing decision. Financing decision on how you can finance. Remember the first one, we are saying that you plan on how you're going to get the revenue and how you're going to spend. Now, financing decision, you need now to make decision on which source of finance is cheaper for you. Do you think it's better you go for loan, or you can use the retained earning, the savings? Where are you going to get the money to finance the business. Therefore, it is called financing decision. It is a decision on how to fund or finance the business. So that is financing decision. And in this one, you can say that the finance manager needs to ensure that the firm raises funds from the cheaper sources. The finance manager needs to ensure that the firm or the company raises funds from the cheaper sources. It raises funds from the cheaper sources. It ensures that they raise funds from the cheaper sources. So we have different sources of raising funds, which we are going to learn in our next topics, right? For example, you can get funds from ordinary shares. You can get funds from retained earnings to finance your business. We can get funds from loans, which we call debentures. Debentures are basically long-term loans. Sasa, or debts. We can also get our money or resources or funds from preferred shares. Now, sometimes it's very difficult. Like right now, the cost of getting loan has gone up. Interest rates are high. The finance manager needs to look at the options that we have and the risk involved and make the decision on which one can we go for. So the next one is called coordination and control role. Coordination and control role. Coordination and control role. Coordination and control role, you say the finance manager needs to ensure that the financial activities are coordinated and controlled. He needs to ensure that the financial activities are coordinated and controlled. He needs to ensure that the financial activities are coordinated and controlled. He needs to ensure that the financial activities are coordinated and controlled at a central place within the organization. The main aim is to avoid misuse. So if there are funds within the organization, it needs to be controlled from one place so that we don't have people misusing money outside in the branches. We need to ensure that there is coordination and control. The next part is investment decisions. That is number 4, investment decisions. So number 3 was coordination and control of funds. The next one is investment decisions. So the finance manager is the one that it is like the head or the engine of the company as a finance manager. So you need to know which areas can I invest in to get the best return. So we are saying, you can write, it should ensure that the firm invests in projects that are viable, and most profitable, projects that are viable and most profitable to maximize the value of the firm, to maximize the value of the firm, stroke wealth. They need to ensure that they invest in projects that are very profitable to maximize the value of the firm or projects or the wealth. The next one is a liquidity decision. A liquidity is concerned with the money that you have at hand, the money that you can easily access. It's called liquid money. It's money that can readily be turned to cash. Now, as a finance manager, there are situations where you might be in demand of real money, the actual cash, to go and use it. How fast can you turn the money that you have into cash? For example, we'll be having situations where people owe you some money, but the people that owe you some money cannot give you that money immediately when you want it. Therefore, that money is not liquid money. For you to run the business, we need money that can easily be accessed or available. So we have investments. For example, we can have investment, for example, with other institutions like maybe treasury bills or Nairobi Stock Exchange. We can go and buy some shares. We can have money on CSE money market. Those monies that we can easily get, we just walk in and get it. We call them liquid money. The fixed deposit in the banks, those are liquid money because they can easily be turned into cash when we want. But money that people owe you might not be liquid because you can't easily get it. Therefore, the finance manager needs to make a decision. How much money do I need in the next 2 or 3 months for investment purposes and for operational purposes? They need to consider how to pay salaries. So they need money that can be easily available. Those are liquidity. So we are saying, you can say, because this money are used as working capital, you can say that liquidity decision, this involves the management of the firm's working capital because it's the capital that you're using to work or to operate. This involves the management of the firm's working capital. It involves the management of the firm's working capital. Liquidity is the ability of the firm. I'll repeat, it is about management of the firm's working capital. Then you say, liquidity is the ability of the firm to meet its short-term recurring financial obligation. Liquidity is the ability of the firm. Liquidity is the ability of the firm to meet its short-term financial obligation when due. To meet its short-term financial obligation when due. The finance manager has a role. The finance manager has a role to ensure that funds are always available. The finance manager has a role to ensure that funds are always available for operational purposes. The funds are available for operational purposes. Let's now look at another role, which is risk management. Risk management. Remember what I said, that liquidity is the ability of the firm to meet its financial obligation when they are due. Yani ability ya kulipa madeni wakati inatakikana, si ati umesota. So it is up to the firm's management to ensure that there are funds that can actually be used for such purposes. Risk management. Umeona finance manager iko na kazi mingi sana. The next one is risk management, and you say that The financial manager should be able to mitigate against risk. The financial manager or finance manager, the finance manager should be able to mitigate against risk. The finance manager should be able to mitigate against risk. The finance manager should be able to mitigate against risk that will affect the operation of the firm. That will affect the operation of the firm. They should be able to mitigate against the risk that will affect the operation of the firm by developing some strategies to minimize the risk. To minimize the risk. To minimize the risk. So those are roles of the finance manager. So in exam, if they ask you about the roles of finance manager, you can just give those ones without specifying whether it is routine or managerial. Just say the roles of finance manager. Let's look at the routine functions of finance manager. Routine functions of finance manager, you can say these decisions are repetitive by nature. These decisions are repetitive by nature. Sorry, so these decisions are repetitive by nature, and one does not require, these decisions are repetitive by nature, and one does not require separate skills to accomplish them. They are repetitive by nature. They are repetitive by nature, and one does not require separate skills to accomplish them. Are we together? Are you guys okay? They include cash, receipt, and payment. That is a routine. You don't need to have a lot of skills to know that you need to record cash, receipts, and payments. Though hiyo ni kazi ya finance manager, but it's something that is quite repetitive. Every day you do it. So an example of these routine functions are cash receipts and payments. Number two, record keeping and reporting. Record keeping and reporting. Record keeping and reporting. Safeguarding of the resources of the farm. Safeguarding farm resources. Safeguarding farm's resources. Safeguarding farm's resources. Let's look at examples of the types of finance manager that we have. Examples of financial managers. These are managers who deal with finances. Let's look at some of them. Examples of financial managers. In an organization, managers who deals with finance, examples are controllers, financial controllers, you know them? We always call them financial controllers. They prepare reports, summarize, and focus the organization's financial position. So they always check on how the company is performing financially. We have treasury and finance officers, those who are working in treasury. Treasury guys, these are also finance team. We have credit managers. They are also part of the team. Why are they part of the team? They manage how funds are being given out, like loans, because those are part of the revenues that you're going to get. Remember, one of the sources of finance for the business is also the loans that are given that generates interest. We have cash managers, like in a bank, we have those who are managing cash. We have tellers, head of cash, we have tellers, we have accountants, cash managers. Cash managers. We have risk managers. Risk managers, insurance managers. Insurance managers. So these are roles that somebody who has done finance can be able to work or get employed with. Let's look at objectives of a firm. What is the main goal of running a business? What is the objective of a firm? Objectives of a firm. Objectives of a firm. Objectives of a firm. You can say that the goals or objectives of a firm can be broadly classified into two categories. Goals or objectives of the firm can be classified into two categories. Goals or the objectives of a firm can be classified into two categories. The first one is called financial objectives or goals. So we have financial goals. Stock objectives. And then we have non-financial objectives. Financial objectives, these are what the organization aims to achieve. So we can start by looking at the financial objectives. Under financial objectives, we have two types or two objectives. The first one is called profit maximization objective. So under financial objectives or goals, the first one is called profit maximization. That is an objective of the firm. This is an objective, or it is the goal. It's one of the reasons why we run the business. Profit maximization objective or goals. So profit maximization, we say, this is considered to be the classical or traditional objective of the firm. It is the old goals of the firm. Traditionally, people knew that the reason why we run business is to make profit. So it is the traditional, or we call it classical or traditional goals of the firm, which involves making the highest profit possible. So this one we normally consider that profit is equal to cost, is equal to revenue minus cost. Clear? So that is the profit that we're looking at. It is a traditional objective. Kitambo ilikuwanga hivyo. But things are changing. The objectives of the companies, why we run companies, are now changing. Let's look at the second objective, which also relates with money. It is the second objective, number 2 here. It is called wealth maximization objective. Wealth maximization objective. That is number 2 under this wealth maximization objective. Now, before we go to that, do you guys think that there is a problem when our main objective is to make profit? Inaweza kuwa na shida yoyote? Is there any drawback or disadvantages of having profit maximization as our main goal when we are running business? Do you think there is a problem with that? Can somebody type there, I see? What is the problem with that? Challenge inaweza kuwa nini? Jafet, Sarah, shida ya hii ni gani? Examiner can ask you, what are the drawbacks? Or what are the arguments against profit maximization as one of the objectives of the firm? So firms may involve themselves in immoral and illegal activities just to make profit. True. And I can tell you that some of the organizations, they market, but when you get their services, it's not exactly what they are marketing. They are not offering what they are marketing. They will tell you how they are the best ones. If it is online colleges, they tell you we are the best. When you go there, you get frustrated, right? Because their main aim is to maximize profit. They don't care about the welfare and the well-being of the customer. So the examiner can ask about employee exploitation. Yes, employees can be drained. You can be put to work excessively as long as they make profit. It is only for short term. That means that the person is myopic. Haoni mbali. Anaangalia tu hapa karibu. We could be making not in the right direction, ways that the firm's reputation is destroyed. Yes, you can make a profit that is not on the right direction. And at the end of the day, it can actually lead to exploitation, and reputation damage. That is very true. It also ignores the future value of that money. You're looking at the money now, but do you look at the future value of that money? Mtu anaweza kuumiza so that he can make profit of 10,000 today. But even if you are to give him that profit, in the next 5 days, that value is not there. They can even avoid tax. That is true. So you can think of those answers that are true in case you are told what are the disadvantages of profit maximization. It is a selfish way of doing business, right? It can lead to reputational damage. It is vague because that is not what we are actually looking at. It can lead to exploitation of the employees, right? That is very fine. So let's look at the wealth maximization goal. Now, there is a difference between wealth and profit. When you make profit, you become rich. But when you are wealthy, you are beyond riches. So somebody who is rich is able to meet his main needs, the desired expenditures you can meet. But profit does not stay forever. Greatness might not take long. If you are wealthy, it means that even if things come down, you can still survive. For example, a wealthy person, that person has everything that is required, that is a rich person. On top of that, you have invested somewhere else. You're not just having money that you can spend today. You're not just driving the vehicle, but you have so much investment outside. The people around you are also financially enabled, so that in case you are sick, in case your account has been blocked by the government, your son, your uncle, your niece, your nephew are also able to help you. Then you are now wealthy. In business, it's not about making the profit, but how much do you invest that is able to generate profit for a longer period. If you put shares somewhere, those shares need to grow, so that even if you're not making profit or you're making profit, the value of your shares still remain, because profit will come and go, but the shares should always remain. Therefore, we are talking about increasing the value of the investors, and that is wealth creation. So the investors are not focused on profit, they are focused on the value of their investment, and that is wealth creation. So we are saying that wealth maximization is the main objective of the fund. It is the main objective of the fund. They are the main objective of the fund. Then you say that under this goal, the cash flows are used instead of accounting profits. Under this goal, cash flows are used instead of accounting profits. It means that under this goal, you're not looking at the profit that you normally count for, the profit, accounting profit. No, they are now looking at the cash flows. In case you don't make profits sahihi, kuna pesa bado itakuwa inaingia. And that is why I'm saying that if you're wealthy, you need to have so many investments so that the cash flow will keep on coming in future. You're not just having what you're using now, but you have future cash flows. So you're saying that under this goal, cash flows are used instead of accounting profits. And such cash flows are always measured in terms of their net present value. So if somebody is telling you that I can make profit of 20,000 in the next 5 years, you tell him no. What is the value of that today? So you're looking at the cash flows, because there is always the time value of money. With time, the value of money goes down. And so that is very important. Okay, so you look at the projects. In this one, you look at the projects that you're having, the revenues that they're able to generate, and such things. So what are some of the advantages of this wealth maximization objective? The objectives of wealth maximization. What are the advantages? Number one, it is seen as a way of improving the value of the shares, the shareholders. The shareholder is able to see that my wealth has grown, the money that I invested has grown, and is able to get me more money in the future. They are not looking at the profit today. So it is seen as a way of improving the shareholders' value. The next one, it focuses on the net present value rather than the profit, which is good. And of course, that is done after deducting the possible costs. So that is a good thing. I'm not sure whether you're on WhatsApp. I want to share something on WhatsApp. Somebody is saying that, could you pardon where you said that the cash flows are measured by? So the cash flows are measured by net present value. They are measured by net present value, NPV. What happens, we are going to look at this in the next topics, that is time value of money, topic number 4. And also capital budgeting, I think topic number 6. what happens is that the value of money today is not the same as the value of money tomorrow. When I was young, that is around 1997, I was very young. We used to buy, before 97, there was no 1,000. This 1,000 that you are seeing, the note was not there. The maximum value of money that was there was 500. So at that time, you could buy a goat, a very big one, a goat at 1,000. But today, the same one you cannot find with 1,000, meaning that the value of 1,000 has gone down. Mbuzi ni ile tu, lakini huwezi buy na hiyo pesa. Kwa sababu, the value of money changes with time. So for us to know, if somebody promises you now that is going to pay you 5,000 in the next 1 year, let him give you that money today. It is better you get it today than getting it in the future. Why? The value of that money in the future will go down. So it is better you use it now when it is still valuable. So if somebody could give you 1,000 in 1997, that one could buy you something better than buying it today. A very big bull by that time was 12,000. 12,000, you could get a very big bull that only goes to Kenya meat. But today, the same one you can get at 60,000. So you can see the difference. The value of 12,000 in 1997 is the same as the value of 12,000, the value of 60,000 today. It means that money has lost the value. Tunaelewana? So, under wealth maximization, we are looking at how much do I have in the future. So I need to discount that future revenue that I'll get in the future. I need to ask myself, what is its equivalent today? Therefore, I get its net present value. It is a future value, but I want to get its equivalent in present date. Net present value. We shall look at that topic. It is a very interesting one. Topic number 4. So, but I wanted to have a good foundation. I was also asking that, are we all on WhatsApp? Is there anybody who is not on WhatsApp? Our classes are basically cheap, 4,500. Then we add you on WhatsApp group for classes where you can be able to get more notes. Right now, I wanted to share some notes about the favorable arguments for wealth maximization and also unfavorable arguments against wealth maximization. I wanted to share that. Also, I wanted to share the differences between profit and wealth maximization. But now, unfortunately, some of you are not in that WhatsApp group. I wish you could pay so that you join there. Whenever we share videos, whenever we share notes, you can easily get them. Yeah? I was saying that our fee is 4,500. Pay bill, you have 880,100. If I'm not wrong, but you guys can confirm. I know you have seen it somewhere. That is a pay bill. Then account number you put. We don't have registration fee. You only pay and then you join. Account number is 44257. 40015. Once you are paid that, you can be able to share with us the M-Pesa message so that we can add you on the WhatsApp group for classes. Tuendelee kuenjoy class. Otherwise, huku nje, utakuwa na lose a lot. Like now, I don't even know how to share it because some of you will miss. Wangapi wako WhatsApp group so that if I share, they can get your paid group. I wanted to share those notes. Differences between profit and loss maximization. There is a table they have done. We can share them. And also the arguments against and for a profit, a wealth maximization. So that one I'll share there. In the meantime, I want us now to look at non-financial objectives. We have looked at the financial objectives, which is the wealth maximization and also profit maximization. Those are objectives, but they are financial. So in exam, you can just give them. If they are not specifying whether it is financial or non-financial, just give any. Let's look at the non-financial objectives. The non-financial objectives include number 1, You say non-financial objectives include number one. Non-financial objectives include number one, welfare of employees. That is not about money, but ensuring that they are not getting profit or getting anything about it, but they're just ensuring that the employees that are working there are also living well. Wanakula vizuri, wanaishi vizuri. That is why organizations exist. So non-financial objectives include employees welfare, employees welfare, number two. So we are saying that they need to take care of employees, like paying them well, motivating them, giving them some bonus, training them, nurturing them so that they can be good managers. That is one objective. Number two, fair dealing with competitors. Somebody talked about bad competition, illegal or unethical business practices. So we are saying that the objective is always to ensure ethical practices. That is a fair dealing. We have shared the notes on WhatsApp. Just check WhatsApp group. The group WhatsApp, for those who are paid, kuna notes tumetuma hapo. That is about the arguments against and for wealth maximization, because there are quite a lot of notes, but already you have them because we have explained them. And then we have the differences between profit and wealth maximization also. We have shared there. Now, we are looking at fair dealing with competitors. That is number two. And we are saying here that the firm should always exercise ethical means of winning customers. You don't do bad things so that you win customers just because of competition. No. Deal with employees and deal with customers and competitors fairly. Don't take advantage of them. The next one is responsibility towards the government. One of the objectives or goals of the government, of the organization, is to ensure that they comply with the government needs or regulations, like paying taxes. So responsibilities towards the government, that is the third one. Non-financial objective, that is a non-financial objective. You say that the firm should ensure that taxes are paid and operations are conducted within the framework, within the legal framework. The firm should ensure that taxes are paid and operations are conducted within the legal framework. That should be their objective, so that you are not, the firm is not closed or the business is not closed. Number four, responsibilities towards customers. They also have objective to treat customers well and fairly. You will say that the firm needs to produce high quality products with fair prices. 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 The next one is the responsibility to the society. I'm sure you have seen companies that are supporting societies. They are giving, like we have Wings to Fly by Equity. We have scholarship by KCB. Those are responsibilities. They are called corporate social responsibility, CSR. Corporate social responsibility. It is a non-financial because it is not giving money to the company, but it is helping the well-being of the society. Remember that the society where we are, that is where we get resources. The employees you get from the society, customers are from the society. The community where you're operating, that is where you get your customers. So sometimes you give back by helping them. Social or corporate social responsibility, right? CSR. So we are saying that is the responsibility towards the society. The firm should ensure that it is in good terms with the community within which it operates by employing them, supporting them, and helping them in terms of their needs, like the education, sometimes food, clothing, barabara. Now, there are some firms that can also go and help. So that is the responsibility to the society. By engaging in corporate social responsibility programs, such as sponsoring the needy students, sporting activities, developing infrastructure like roads. The next one, also employ the people around you, because those people are the customers. So you can't go and bring employees from somewhere else when you are selling to us. We will send you away. Responsibility towards creditors and suppliers. Responsibilities towards creditors and suppliers. And we are saying the firm should always honor its financial obligation without fail when they fall due. The suppliers have given you goods to run your business. When they need their money, please be able to pay them. That is a responsibility, and that is your objective or your main goal, is that you pay your liabilities, lipa deni. Now, I want us to look at that is a responsibility towards suppliers or creditors. They need to pay when they fall due to improve their credit rating, Let's look at the objectives of financial management. What is the objective of financial management? Why do we manage finance? Objectives of financial management. Objectives of financial management. Why do we manage our finances? Number one, to ensure that we have regular and adequate supply of funds, to ensure that we have money when we require. Hata nyumbani, hakikisha manage pesa yako vizuri, so that you don't have problems. You keep on unashinda ukiombaomba pesa, sindio? So we manage finances so that we can have adequate and regular supply of funds for use, to ensure regular and adequate supply of funds for use. Also to ensure better returns, the shareholders. We manage money, we manage finances to ensure better returns to the shareholders, to ensure adequate returns or better returns to the shareholders, to ensure better returns to the shareholders. The next one, to ensure safety of investments. We talked about risk management. That is the role of finance people. Why do we manage risk? So that we can be able to invest on safety projects. We can put money areas which are of safety and we are not going to lose. Some people have invested in housing. Unasikia mtu amebuy shamba mahali imepotea, ameweka pesa sijui wapi imepotea. Means that he lacks financial management knowledge. Now, when you are done with the CPA, you should be a good finance manager. You go and advise them, right? Yes. So we are talking about ensuring safety of investment. So we are saying that funds should be invested on safe businesses or ventures. Funds should only be invested in safe ventures so that we can have a good return. The next one is to ensure optimal fund utilization. 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 Let's look at another subtopic that is very examinable. It's called agency theory. Agency theory. Agency theory and problem. Now, you know what agent is, right? An agent is somebody who is acting on behalf of his boss, and his boss is called principal. Now, when somebody is doing something on your behalf, that person is your agent, and you are the principal. Now, even in politics, the MPs, the president is our agent. We are the principal. We are the ones who have employed him. We gave you an opportunity to act on our behalf, make decision on our behalf. But sometimes we have problems in this agency thing. You give somebody authority to act on your behalf, but he's doing his own things. So we have problems with it. Right now, we have such problems with politicians, right? Where you employ somebody, once amekuwa president, anaanza kufanya vitu zake. So therefore, we have problems with agency. Now, this theory believes that there are two people. One person is the agent and the principal. And then sometimes in the course of their work, we can have problems. Let's look at this. You can say that agency theory is a concept. 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 Agency theory is a concept that tries to explain the relationship that exists Agency theory is a concept that tries to explain the relationship between different shareholders. Agency theory is a concept that tries to explain the relationship that exists. It tries to explain the relationship that exists between different shareholders or related parties in an organization. So we want to bring the agency theory in an organization perspective. It tries to explain who is an agent in the organization and who is the principal. So what is the relationship between various parties in the organization and what is causing the problem? Right now, I am an auditor by profession, by the way. I am an auditor by profession. So right now we are dealing with a certain organization which has got chaos. What happens is that it is a circle. It is a circle, and the shareholders, which are the members, contributed money to run the circle. But the management decided to take the authority, the powers that they are given to misuse. They are misusing their powers. They will take loan from the bank and use for personal use. They are able to take people's money. They go and buy plot in their name. So right now we are involved in a situation where the financial statements are being overstated so that they can lie to the members that they are making profit, when in reality, the circle has been looted. So it means that the members are the principal. They have employed employees who are the agent to take care of their resources, but instead, they have started misusing the funds and the circle is going down. To an extent that they are reporting that they are making profit of, they are having an asset base of 8 billion when the circle is only worth 1 billion. So you can imagine they have overstated it by 7 billion. Agency theory problems. Somebody comes in with his own interest. That is why we are saying there is a problem here. So you need to understand, as a finance manager, what causes this and how can it be solved? So in case you become a director a chairman, treasurer, or the CEO, you understand it. We are saying that this theory tries to explain the relationship that exists between stakeholder, not just shareholder, stakeholders, between stakeholders or related parties in the organization. So we are saying that agency problem refers to the second line. You say that agency problem refers to the conflict of interest. Problem comes when people have different conflicts or different interests. So agency problem refers to the conflict of interest that exists between the various parties to an agency relationship. Agency problem refers to the conflicts. Agency problem refers to the conflict of interest. Agency problem refers to the conflict of interest that exists between the various parties to an agency relationship. Let's look at the types of agency relationship. We have been talking about agency relationship. What are the types of relationship that exist in an organization? So talk about the types of agency relationship. In an organization, types of agency relationship in an organization. The first one is called shareholders and management. So who is an agent here and who is the principal? Under these arrangements, shareholders and management. Who is the agent and who is the principal? Somebody to assist. Who is the agent here and who is the principal? The next one is shareholders and creditors. Shareholders are the principal, management is the agent. Thank you so much. The other one is shareholders and creditors. We have shareholders and the government. Kindly make some nice notes. I'll buy those notes from you. At the end of the semester, I'll want to take the notes from you at a fee. Shareholders and government. Then we have shareholders and auditors. Shareholders and auditors. We have shareholders and auditors. We have parent company and subsidiary. Parent companies and subsidiary. We have managers and employees. managers and employees. We also have managers and employees. So let's look at the shareholders and management, into bracket directors. You know, directors are also appointed by the shareholders. Shareholders and management or directors. Then you say that shareholders are the owners of the firm. Shareholders are the owners of the firm. Shareholders are the owners of the firm. They are the owner of the company. However, they cannot manage the firm because, number one, however, they cannot manage the firm because, number one, there are too many to run a single business. There are so many, they cannot all be there. There are so many to run a single business. There are so many to run a single business. That can make them not to be in the company, all of them. Number two, they may not be having the technical skills and expertise required to run the business. They are the owners though, but they might not have the technical capabilities and expertise to run the business. They might not have the technical capabilities and expertise to run the business. That is another reason why they have to appoint somebody to do it for them. We are trying to look at reasons why the shareholders cannot run the business, but they give them to the management. Number one, because there are so many, not all of them can fit in the company to run. Number two, they don't have the right skills. Number three, they are geographically dispersed and may not have time to always be in the company. So you can be a shareholder of a company, but you are not living in Kenya. You can be a shareholder, you are somewhere else. Because of that limitation, you might now appoint somebody to come and run it for you. So you say they are geographically dispersed and may not have time. They are geographically dispersed and they might not have time. So you say that therefore, the second paragraph, therefore, shareholders appoint directors or management to run the organization on their behalf. Therefore, they appoint directors or management to run the organization on their behalf. Therefore, they appoint directors to run the organization on their behalf. The shareholders are therefore the principal, while the management are the agents. Continue like that. Shareholders are principal, while the management are the agents. Let's now look at the sources of conflict between the two. Shida inatokea wapi? Sources of conflict between the shareholders and management. Mahali tumeanza kukanyaga sasa, hizo ni mtihani. They bring them in exam. Number one, what causes the problem? Causes of conflicts. Number one, incentive problem. Incentive problem. incentive problems. That is the first one. So how does this come? We are saying that managers want to fix a higher salary. Managers want to fix a higher salary, but do not want to work hard to maximize the shareholders' wealth. Managers want to fix their salaries that is quite high, but they don't want to do the same for shareholders. They don't want to work hard to maximize the shareholders' wealth. So managers' salaries are always fixed. Whether they're not working hard, you'll always pay them. So they want to have a fixed salary that cannot be reduced. When the shareholders' wealth, the return is always flexible, keep on changing. And if they don't work hard, they cannot do it. The next one is misuse of corporate resources for personal gain. 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 Number two, the next one, different perception of risk. Hiyo pia inaleta shida. Shareholders have brought the money. Wewe manager, you don't have any resources here. Alafu unachukua hii pesa unaenda una misuse. So you don't see the risk that you are seeing. You don't see the risk that you are seeing. Because it is my money I've pumped in. When I told you to manage it for me, you are taking the money and investing in a risky investment. I'm going to lose. You are not losing anything. After all, wewe unapata salary na pesa yako haiko hapo. Unaelewa? So we are saying that different perception in terms of risk, where we always want to see that we get a good return, but not high risk. The next one, alternatively, management might also have it differently, where they can see that if you invest in a higher risk business and the company falls, they are going to lose jobs. That is also possible. So I can decide that I want you to invest in a very risky business and give me higher return, but you are looking at it like you're going to lose job in case the business falls. So our different perception, depending on from where you're looking at it, it can actually cause some problems. The next one, the need for leisure and freedom. Need for leisure and freedom. Employees require free time. They are not working hard. They just want freedom. They do their own thing. They take monies, go and celebrate parties, They just need leisure. They are going out. They are going on training, which is not even valuable. Instead of working for us to get money, they are always there loitering out. So that need for pleasure and freedom by employees is also another challenge. They're using this freedom that we have given them to reward themselves. They are taking allowances, going on trip, misusing our resources. The next one, creative accounting. Creative accounting, or in other words, cooking books. When these guys are cooking books, management are cooking books, they can make the company go down. They want to cook books so that they can show that they are making profit, so that we can give them promotion, we give them bonus, we give them salary increment. When cooking the books, like I had showed you, it is a problem. We can't allow them. The next one, so cooking of books, which involves the application of accounting rules and policies to generate this desired results, which is not the correct one. They are creative accounting. Creative accounting involves cooking books where the management can apply accounting rules and policies to generate the desired rules. This practice might hide the truth. This practice will hide the truth about the financial statement of the company. The next one is pursuing power and esteem goals. 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 You say, this is called empire building. This is called empire building. That is number 7. Is it number 6 or 7? It's called empire building. It is normally done through mergers and acquisition. Managers can do this. Managers can do this. Managers can do this through mergers because they believe they can do this through mergers because they believe that companies, they believe that big companies have got higher returns. Managers can do this because they believe that big companies have got higher returns. They believe that big companies have got higher return. So they want to do this so that they can have more power and influence. So they can organize mergers and acquisition so that they can benefit themselves. The next one is discriminatory employment practices. So you can find that the management are employing people according to their tribe instead of focusing on bringing people on board, people who are able to work. They are bringing people because of their tribe. So this involves employing people based on corruption, tribalism, which will hinder the efficiency of the operations. So you find that the management, the senior manager, the HR bring people from their tribe, which will affect the operation, and they forget about the maximum production. So that is let's stop there. We shall look at ways of solving this kind of conflicts, ways of solving the conflicts in our next class. I still encourage those who have not paid, please kindly pay so that you join class. Our number still remains the same, 0720-525-000. This is the first lesson. We shall complete or finish the topic in the next lesson and start topic number 2. My main aim is to look at topic number 5 and 4, where we shall start calculations, a time value of money. So thank you so much. Semester is not on our side, so let's do it early so that we can finish and do revision blocks. Any question? Any question? In Phoenix, Benti. My name is CPA Dennis. Our number is 0720-525-000. We only charge 4,500 per unit. That includes notes. That includes live classes. and revisions. Sawa. We also have option for videos. In case you're busy, you can take the option for videos. Tuko pamoja? So tumemaliza hiyo story. Let's meet in our next class. Thank you so much. Yes, have a good evening.